Why is no one talking about this? The U.S. banking industry stands on a dangerous precipice as over $2 trillion worth of commercial real estate loans mature in the next 16 months. Warren Buffett has sounded the alarm because there are hundreds of small banks that risk failure, especially as the Federal Reserve raising the interest rate squeezes the banks from both sides. I want to take a look at some numbers that paint a picture of what is to come and what we can expect if the brewing storm in the banking industry spills over to the larger economy. Obviously, this is not financial advice, but subscribe to the channel for more content like this and watch what Warren Buffett just said in a couple of months ago before I tell you more about it.
We have had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, there's plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact.
It only sounds fair on the surface, right? You make a risky investment, you lose, and you bear the loss. But unfortunately, the banking sector is different as an industry because failure of the banks means a cascading impact across the entire economy. Right now, more than $929 billion worth of commercial real estate loans are maturing by the end of 2024. That's a mere 4 months from now. And then an additional $1 trillion+ of loans are coming due until 2026. Considering the inflation rate, rising interest rates, and employment numbers, there's a very real chance that a lot of defaults and bankruptcies could happen in a sector of the economy that is already seeing a massive downturn after the lockdowns of 2020. Foreclosures of commercial real estate properties back in March had already jumped a massive 117% compared to 2023, signaling a brewing panic as the end of the year approaches and hundreds of billions worth of additional loans mature. It is estimated that if loan repayments fail or made too late, banks could see a loss of 10 cents on every dollar of their reserves. While a big bank may be able to absorb the shock, small banks are in much greater danger. The United States banking sector is overwhelmingly composed of small community banks defined as having under $10 billion assets. That's 97% of the total banking sector. If a domino effect starts in these small banks, it could very quickly move up and cascade into the biggest banks.
Meaning that you don't think anything needs to be done on the commercial real estate front?
Well, I think that the people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
Banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it. But that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking. It's not a sure thing on every loan, and you build that into your calculations, and then you have capital that protects your depositors from it eating into their money. And if it does eat into their money, then the FDIC, which is in effect really a mutual insurance company of a very peculiar sort, essentially spreads the losses among the continuing banks by higher FDIC assessments in the future.
It is estimated that nearly a third of all commercial real estate loans in the United States are non-recourse loans, and I think that's something that even Warren Buffett would be worried about. Non-recourse loans are basically a kind of shield for the borrower at the time of signing their contract. That prevents the bank from going after individuals if the collateral doesn't cover their losses in the event of a default or foreclosure. Unfortunately, many banks in the US have made bad deals in the last few years, seeing as the Federal Reserve has kept interest rates super low and the cost of borrowing down as well. That has changed this year, with the Federal Reserve raising interest rates to more than 5.3% and then announcing that they will stay at the 20-year high until the inflation levels cool. That obviously is going to happen by discouraging borrowing and spending, inevitably further squeezing the banking sector. It's that perfect storm that many smaller banks in the US face right now, and a lot of them are even looking at the government for the protection of a bailout in case something bad does happen. But there's no guarantee that something like that would be feasible unless the domino effect grows all the way to the biggest banks. Even back in the 2008 financial crisis, the government used the taxpayers' money to bail out banks that were supposedly too big to fail, but if they were too big to fail, then perhaps they were simply too big, and a series of bad decisions by smaller banks should not be allowed to snowball into a much larger problem in the entire banking sector, to the point that the government and the taxpayers have become the unwilling savior once again. For someone like Warren Buffett, perhaps neither the bank nor the borrower are free of the blame, because one took out non-recourse loans to invest the commercial property market, while the other took the gamble and tried to take the risk in hopes of greater reward.
Most people like to buy with non-recourse in real estate, and one time I asked Charlie, there was some real estate guy we were talking to, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name. And if you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business, and it does mean then that the lenders are the ones that get the property, and of course they don't want the property usually, so then the real estate operator counts on negotiating with them, and the banks tend to extend and pretend, and there's all kinds of activities that arrive out of commercial real estate.
Unfortunately, as much as the government may want to take a completely hands-off approach this time and let the small banks suffer the consequences of their mistakes, it would not be feasible to do that if the problem grows larger instead of just a few community banks. It's a sad reminder of how loose regulations, especially after the 2008 financial crisis, have landed us in a similar spot. We'll have to see what happens in the coming months, but Warren Buffett's warning of the underlying philosophy to letting the small banks fail is certainly worth a thought when it comes to the long-term health of the banking sector. Let me know in the comments whether you agree with the broader idea of creative destruction being allowed to reign supreme in a sensitive market like banking, because any government tinkering with it is probably going to have long-lasting adverse effects that eventually land us back to square one every few years.